Something just shifted in the gold and silver markets. And most people watching their portfolios today have no idea it happened. A number is coming this week, a quiet number, buried in a government report. And when it lands, it could decide whether the next 6 months bring stability or a shock that catches millions of investors completely unprepared. Because behind the scenes, 4 forces are converging at the same time. CPI, Iran, Comex, China. Separately, each one would matter. Together, they may be building towards something far bigger. Stay until the end. Because what happens next could change how you think about your own money. Welcome back to Precious Metals Intelligence, the channel dedicated to cutting through noise and delivering strategic, decision-grade analysis of the gold and silver markets. If you're new here, this channel exists for one purpose: to help serious, forward-thinking individuals understand what is actually moving these markets. Not hype, not headlines, but the structural forces underneath them. Before diving in, a respectful ask. If this kind of grounded, no-nonsense analysis is useful to you, consider subscribing. It genuinely helps this channel continue producing independent research free from sponsor bias. And one more thing, we'd love to know, where in the world are you watching from today? Drop it in the comments. This audience spans nearly every continent, and it's always remarkable to see how far these conversations travel. Now, let's get into it. For months, the gold and silver markets have felt unusually calm. Prices have moved, but not wildly. Traders have watched, but without panic. To a casual observer, it might look like nothing important is happening. But analysts who study these markets closely know something different. Calm periods like this one rarely last. They are often the quiet before a much bigger move. And this week, one single number could be the spark that ends the calm. That number comes from the Consumer Price Index, widely known as CPI. It is a monthly report that measures how much prices are rising across the economy. Everything from groceries to gasoline to rent. On the surface, it sounds like a dry government statistic. But for people who understand how markets work, CPI is one of the most powerful forces shaping the price of gold and silver. Here is why it matters so much. When inflation rises faster than expected, it signals that money is losing value more quickly. Investors around the world respond by moving toward assets that historically protect wealth during inflation. And gold and silver have played that role for thousands of years. On the other hand, if inflation comes in lower than expected, it can strengthen the belief that the economy is under control, sometimes causing investors to pull back from precious metals in the short term. This creates 2 very different paths for the market this week, and both are worth understanding. In the first scenario, the CPI report comes in hotter than expected. Prices are rising faster than economists predicted. If this happens, it usually raises fears that the Federal Reserve may need to keep interest rates higher for longer, or even raise them further, to slow down inflation. In the short term, this can actually push gold and silver prices down, because higher interest rates make it more expensive to hold non-yielding assets like precious metals. Investors would rather earn interest in a bank or bond than hold metal that pays them nothing directly. So a hot inflation number often creates short-term pain for gold and silver, even though it may not change the long-term picture at all. In the second scenario, the CPI report comes in at or below expectations. This suggests inflation may be cooling, even slightly. In that case, markets often become more comfortable with the idea that interest rates could eventually come down. Lower rates historically support higher gold and silver prices because the opportunity cost of holding metal instead of cash goes down. A cooler than expected number could therefore act as fuel for a rally, especially if the market has been coiled and waiting as it appears to be right now. But here's the part that many casual investors miss. Whichever way the number lands this week, it is important to separate the short-term reaction from the long-term trend. A single CPI report is what analysts often call noise. It causes a quick reaction, sometimes a sharp one, but it does not by itself change the deeper forces driving inflation over years, not days. Government spending, currency devaluation, and long-term debt levels move much more slowly than a single monthly report. These are the forces that truly determine where gold and silver are headed over the next several years, not one Wednesday morning data release. This is why serious, long-term investors try not to panic over any single number. They watch it, they understand it, but they do not let it control their entire strategy. The real question is not simply, will CPI be hot or cold this week? The real question is what this number represents inside a much larger pattern that has been building for months. Because CPI is not moving in isolation. It is landing in a market that is already under pressure from other directions at the same time. Tensions are rising overseas. Positioning inside the major futures markets is becoming unusually tight. And halfway around the world, one of the largest economies on Earth has been quietly and steadily accumulating gold for years, with very little attention from Western media. Taken alone, the CPI report might seem like just another data point. But when it is placed next to everything else now converging on this market, geopolitical stress, tightening supply, and strategic accumulation abroad, it starts to look like one piece of a much bigger picture. And that picture is what makes this particular moment different from the quiet months that came before it. The next question worth asking is simple. If inflation is only one part of the story, what is happening in the Middle East that is adding even more pressure to this already fragile balance? Money is not the only thing that moves gold and silver. Fear does too. And right now, fear is quietly building in a part of the world that has shaped precious metals prices for decades, the Middle East, and specifically, the rising tension surrounding Iran. To understand why this matters, it helps to step back and look at how markets have behaved throughout history whenever conflict or the threat of conflict increases in this region. Gold has long been called a safe haven asset. This means that when investors feel uncertain about the future, when there's a real risk of war, disruption, or instability, they often move money out of riskier investments like stocks and into assets that have held value for centuries. Gold sits at the very top of that list. Silver, though more volatile, tends to follow a similar pattern, especially when the fear spreads into energy markets as well. Iran plays an outsized role in this story because of its location. It sits along the Strait of Hormuz, one of the most important shipping routes in the world for oil. A large share of the planet's oil supply passes through those waters every single day. Any escalation involving Iran, whether it is military action, sanctions, or disrupted shipping, creates immediate concern about oil supply. And when oil supply is threatened, energy prices tend to rise, inflation fears grow stronger, and investors once again turn toward gold as protection. In this way, Iran does not just affect gold directly, it affects gold indirectly too, through its influence on oil and inflation expectations. This is what analysts mean when they talk about a geopolitical premium being added to the price of gold. It is the extra value the market places on gold simply because the world feels less predictable. This premium is different from the kind of demand driven by inflation data or interest rate decisions. It is driven purely by uncertainty and fear. And uncertainty does not move slowly. It does not wait for a scheduled report to be released on a specific Wednesday morning. It can appear suddenly, overnight, in response to a single headline, a single statement, or a single unexpected event. This is an important distinction for anyone trying to understand where gold and silver may be headed. Inflation-driven demand tends to build gradually based on economic data that comes out on a predictable schedule. Geopolitical demand can strike without warning. A single piece of news out of the Middle East can move markets faster and more sharply than months of economic reports combined. This is part of why professional traders and long-term investors pay close attention not just to economic calendars, but to geopolitical developments as well, even when those developments seem distant from their daily lives. There's another layer to this story that is easy to overlook. Rising tension with Iran does not only affect sentiment, it also affects the behavior of central banks and large institutional investors, many of whom hold enormous reserves and must think in terms of decades, not days. When these large players see rising instability in a critical region of the world, some of them quietly increase their gold holdings as a form of insurance. This is not panic buying. It is strategic positioning, done by people whose job is to prepare for scenarios most ordinary investors never think about until it is too late. This pattern is not new. Throughout history, whenever tensions in the Middle East have escalated, gold has often responded with a noticeable increase in demand even before any actual conflict takes place. The market does not wait for certainty. It reacts to probability. And right now, the probability of continued instability involving Iran is being priced into the market in real time, even as most casual observers remain focused only on domestic economic data like CPI. This is why understanding gold and silver requires looking beyond a single country or a single data release. It requires understanding how fear, energy markets, and strategic positioning all interact with one another. Inflation numbers explain part of the current market movement. Geopolitical risk explains another part. But neither of these forces operates in isolation. They are beginning to overlap, creating pressure from more than one direction at the same time. And this overlapping pressure raises a deeper question. If everyday investors are watching inflation reports and cautious investors are watching geopolitical headlines, what are the largest and most sophisticated players in the market actually doing behind the scenes, inside the exchanges where gold and silver contracts are bought and sold every single day? Behind every headline about gold and silver prices, there's a market that most people never think about, yet it quietly controls much of what happens to the price on any given day. That market is Comex, short for the Commodity Exchange, based in New York. It is where the vast majority of gold and silver futures contracts are bought and sold. Understanding what is happening inside Comex right now is essential to understanding why this moment feels different from ordinary market movements. To keep things simple, a futures contract is essentially a promise. It is an agreement to buy or sell a certain amount of gold or silver at a set price on a future date. Most people who trade these contracts never actually take delivery of physical metal. They are trading paper promises, not bars sitting in a vault. This system works fine most of the time, because very few people ever ask for the actual physical metal behind their contract. But problems can arise when the number of paper promises grows far larger than the amount of physical metal actually available to back them. This is where the current situation becomes important. Analysts who track Comex inventory data have noticed a pattern worth paying attention to. The amount of physical silver and gold sitting in Comex warehouses has been under pressure, even as the number of outstanding contracts tied to that metal remains high. In simple terms, more people are holding paper claims to metal than there is metal readily available to satisfy every claim at once. If a large number of contract holders suddenly decided they wanted the real thing instead of a paper promise. Most of the time, this imbalance does not cause any problems, because most contract holders are content to settle in cash rather than demand physical delivery. But markets are built on confidence, and when confidence starts to shift, even slightly, the imbalance between paper contracts and physical supply becomes far more important than it was the day before. This is the basic mechanism behind what is often called a short squeeze. It happens when a large number of traders who have bet on lower prices are suddenly forced to buy back their positions, usually because prices are rising faster than they expected. This buying pressure can then push prices even higher, forcing even more traders to buy back their positions, creating a cycle that feeds on itself. It does not require some rare, isolated event. It requires nothing more than growing pressure inside a system that already has very little room to absorb a sudden increase in demand. History offers some perspective here, though not certainty. There have been moments in the past when tight positioning inside Comex combined with a sudden rise in demand led to sharp, fast price movements in silver in particular. Because silver's total market size is much smaller than gold's, this means it often takes far less money flowing into silver to move its price significantly compared to gold. Analysts describe this as silver being more sensitive or more reactive to shifts in supply and demand. It is one reason serious investors watch silver positioning closely, even when gold dominates the headlines. None of this guarantees that a squeeze will happen, and responsible analysts are careful not to promise outcomes that are impossible to predict with certainty. What can be said is that the structural conditions inside Comex right now, tightening inventories alongside heavy contract positioning, represent a real and measurable risk, not just a theory. It is the kind of setup that, historically, has preceded periods of unusually sharp price movement, even if the exact timing is impossible to know in advance. What makes this moment even more significant is that this pressure inside the U.S. market is not happening in isolation. At the very same time that Comex inventories are being closely watched, a much larger force has been quietly building on the other side of the world. It has been building for years, largely outside the attention of most Western investors, and it may be adding even more weight to an already fragile balance. That force is coming from China, and understanding what China has been doing with gold and silver may be the piece that ties this entire story together. While much of the world has been focused on inflation reports and stock market headlines, one of the largest economies on Earth has been moving in a very different direction, and it has been doing so for years. China has been steadily adding to its gold reserves, quietly and consistently, without the kind of dramatic announcements that usually accompany major financial decisions. This pattern is not new, but its scale and persistence deserve far more attention than they typically receive. To understand why China is doing this, it helps to think about the position China finds itself in on the world stage. For decades, the US dollar has served as the primary currency for global trade and as the main reserve currency held by central banks around the world. This arrangement has given the United States significant influence over global finance, but it has also created a form of dependency that some nations, China included, have grown increasingly uncomfortable with, particularly after watching how quickly financial sanctions can be used as a tool of foreign policy against other countries. Gold offers an alternative. Unlike a currency issued by another nation, gold is not controlled by any single government. It cannot be frozen, restricted, or devalued through the monetary policy decisions of a foreign central bank. For a country looking to reduce its dependence on the dollar and diversify its reserves, gold represents a form of financial independence. This is widely believed to be a central reason why China has continued accumulating gold year after year. Even during periods when prices were already elevated, silver has followed a somewhat different but equally important path. In recent years, both the United States and China have formally classified silver as a critical strategic mineral. This label matters because silver is not only a form of money and a store of value, it is also an essential industrial material. It is used in solar panels, electronics, medical equipment, and a wide range of technologies considered vital to national infrastructure and future energy systems. When a government labels a resource as critical, it often signals that the country intends to secure its supply, sometimes even restricting how much of that resource is allowed to leave the country. This is exactly what has been happening with China's approach to silver. Reports have pointed to tightening controls on silver exports, with the government paying closer attention to where the metal goes and how much leaves domestic markets. When one of the world's largest consumers and producers of a resource begins restricting its flow outward, it naturally places additional pressure on global supply, particularly at a time when industrial demand for silver continues to grow due to expanding solar energy production and electronics manufacturing worldwide. When these pieces are placed side by side, a broader pattern starts to emerge. China's long-term gold accumulation reflects a strategic move away from dependence on the dollar. Its tightening grip on silver exports reflects a recognition of silver's growing industrial and strategic importance. Neither of these decisions was made suddenly or in response to a single event. They reflect years of deliberate, forward-looking planning by a government thinking many years ahead, not merely reacting to this week's headlines. This is what makes the current moment so significant. The CPI report reflects short-term economic conditions inside the United States. Rising tension involving Iran reflects immediate geopolitical risk. Tightening conditions inside Comex reflect structural pressure building inside the paper market for gold and silver. And now, China's long-term strategic accumulation adds a fourth layer, one that has been building quietly for years and shows no clear sign of reversing. Four separate forces, each powerful on its own, are now converging at nearly the same moment. One is a monthly data release. One is a geopolitical risk. One is a structural imbalance inside the exchange. And one is a multi-year strategic shift by one of the largest economies in the world. Individually, any one of these might be manageable. Together, they raise a much larger question about what could happen if all four continue moving in the same direction at once.